Okay, so this is the second video today, and I'll try to go through it fast. The first one explored the subject of choosing the strike of the short leg of the poor man's covered call. In this video, I focus on the long leg or leap option. Specifically, I'm going to test 3 leap options with 110 days to expiration. A 425 strike 50 delta, a 400 strike 74 delta, and a 350 strike 89 delta. So common wisdom, if there is such a thing, seems to favor the 80 delta option. But look at the difference in price. As we increase delta from 59 to 89, the price of the leap quadruples. The cheaper leaps undoubtedly offer more crash protection. If the shares crash way below 425, then all the leap can do is go to 0. Whereas you could lose all your money, 4 times the money if the shares went below 350. Anyway, the short call in all cases is going to be a 435 strike with 33 days expiration and a delta of -50. So it's at the money. I modeled both options using my Black-Scholes spreadsheet, and I use a sticky delta model to estimate IV as time evolves and the underlying changes in price. So I'll show these graphs repeatedly, and so let me explain the curves. The solid green line is the change in the share price over the life of the short call. So in this case, SPY rose by $14. The dotted blue curve is the net value of the spread. In this case, the spread increased by $4 in value. So by trading the spread, we captured $4 of the $14 of available profit, or about 30%. So the dotted green line shows how much potential profit we've captured. Okay, so in this case, the short call has -50 delta. And actually, in all cases, the short call has -50 delta. And since the leap has a delta of +59, the net delta is +9 when we open the spread. So this spread stays profitable until the end, but I will always roll at 10 days to expiration as a matter of course. Now let's look at a 74 delta leap. This position is 24 net delta when I open it, and it reliably captures about 40% of the increase in the underlying. Now let's check the performance of the 89 delta leap, which gives us net 39 deltas. This is definitely more directional to the upside than the first 2 cases. It's about like having 40 shares of stock. But you can see we capture 50 to 60% of the available increase in the share price. Okay, now let's see how the spreads perform when the underlying decreases. The 59 delta leap spread actually has a mild profit for the first 15 days when theta decay works in our favor. I like to roll the short call at 35 delta, which seems to be the point where the P&L goes negative, really with all these spreads. So I typically buy 75 delta leaps, so this position here is really the one that I'm currently trading, or close. So for the first 15 days, the P&L is only mildly negative. We're only exposed to about 10% of the decline in the shares. But as time goes on, the P&L curve tends to parallel the P&L curve of the shares alone, meaning the delta of the position goes to 1. So again, I find that when the short call goes to 35 delta, that's a great time to roll. That's typically when the P&L starts to bend downward. So last, we'll look at the 89 delta leap. It's actually slightly positive for a few days and then fairly flat for a while. Again, out to that when the short call goes to about 35 delta range. All right, so takeaways on how to select the strike of your leap in the poor man's covered call. I tested 3 cases, 60, 75, and 90 delta. The 90 delta leap was almost 4 times more expensive than the 60 delta leap, but only captured 2 times as much available upside as the 60 delta leap when the SPY increased. And the 60 delta leap appears to offer slightly superior downside protection relative to the 75 or 90 delta cases. So again, in all cases, I do recommend selling at the money short calls I know that goes against the conventional wisdom, but in the previous video, I did some experimentation there, and I do like the performance of the 50 delta short calls. And I always roll at 35 delta if the price is declining. Though I don't desperately roll when the share price increases. I might let it ride out to 10 days. So my takeaway, so if I wanted a net 20 delta position in a stock, so say from an allocation standpoint, I wanted to hold 20 shares of SPY. I would rather have two poor man's covered calls with 60 delta leaps and a net delta of 10 than one poor man covered call with a 70 delta leap, which is also net 20. It would have the same cash cost to buy the two poor man's covered calls, yet it would capture more upside and seems to have better downside protection. So this was a very interesting conclusion for me, a little bit unexpected actually. So it's actually going to change the way that I trade. So anyway, hope you enjoyed that, and would love to hear your feedback. Yeah, if you like it, hit the like button. If you don't like it, don't hit the like button. And subscribe if you want to. Anyway, I'll see you later.